all right? Today we're going to tackle one of the most fascinating and, let's be honest, kind of morbidly named concepts in all of finance. It's a trap that has cost investors absolute fortunes. And, understanding it is absolutely crucial if you want to survive a bear market. I know. It's a pretty grim image, right? But this old Wall Street saying just perfectly captures the essence of what we're talking about today. It's not about life, it's not about a real recovery, it's about a pure mechanical reaction. And in the market, mistaking one for the other, well, it can be absolutely devastating. So let's get into it and decode this strange piece of market jargon. What exactly is a dead cat bounce, and why on earth does this grisly metaphor stick around? Okay, at its very core, it's this: a moment of false hope. You see an asset's price just fall off a cliff, and then, suddenly, it rallies. It looks like a recovery, it feels like the worst is finally over, but it isn't. It's just a temporary little blip before that downtrend kicks back in, often leading to even lower lows. The power of this term, which popped up back in the volatile markets of the 1980s, is all in that imagery. It just brilliantly communicates that the bounce has zero fundamental strength behind it. Just like the cat in the old saying, this bounce isn't a sign of life, it's just a mechanical reaction to a catastrophic fall. So why do these traps even happen? Well, it's not random. There are some really powerful forces at play here. It's a mix of cold, hard market mechanics and some all-too-human psychology. We can really break down the drivers into two main buckets. On one hand, you've got the technical stuff, let's call it the plumbing of the market that can force prices up for a little while. And on the other hand, you have our own human psychology, all the emotional biases that make us want to believe the recovery is the real deal. So, the biggest mechanical driver is something called a short covering squeeze. Here's how it works. Traders, called short sellers, are betting that a stock's price is going to go down. So after a massive drop happens, they have to buy back shares to close out their trade and take their profits. Well, this sudden flood of buying creates a really powerful but completely artificial surge in demand that spikes the price up. And this is where our own brains kick in and turn that little mechanical spark into a wildfire. See, when a stock falls from, say, $100 down to 10, our brain anchors to that original high price, making a bounce back to 15 seem like an incredible bargain. And during a crash, we're just starved for any good news, so we fall for what's called confirmation bias. We see any little uptick as proof that the worst is over. Then FOMO, the fear of missing out, kicks in and pushes us to jump back in at exactly the wrong time. It is a textbook sucker's rally. Now, this isn't just some abstract theory. This is a pattern that has repeated itself in pretty much every major market crash in history. Let's just look at a few classic examples. Think back to the dot-com bust, right? Doomed tech stocks would fall 80%, then suddenly shoot up 30%, luring in all the bargain hunters right before sliding all the way to zero. Or how about 2008? Bailout news would trigger these massive rallies in bank stocks, creating this powerful illusion of recovery before they crashed to brand new lows. And of course, more recently, we've seen this play out over and over with meme stocks, where social media hype creates these huge bounces that have absolutely no connection to actual value. So all of this, it leads to the million-dollar question for any investor, right? How in the world can you tell the difference between a dead cat bounce and the beginning of a real sustainable recovery? Well, there are some key differences to look for. A dead cat bounce, it happens with no real change in the company's story. A true reversal, on the other hand, is backed by actual good news. A fake bounce is often a really sharp V shape that just quickly fizzles out. A real one, it builds a solid base of support. And this is probably the most important one. Check the trading volume. A dead cat bounce happens on low or dying volume. A true recovery is confirmed by high increasing volume, and that shows real conviction from buyers. Okay, so let's bring this all together. What's the key takeaway here? How do you actually protect yourself from this classic and very costly market trap? Look, the greatest danger is trying to be a hero and catch a falling knife. That temptation to buy after a huge drop, it's immense, but it is so often a fatal mistake. Your number one defense against the dead cat bounce is simply patience. And if you need a really stark reminder of the stakes, just think about this for a second. Buying into a stock after a huge fall, only to see it fall again, that can lead to the near total annihilation of your capital. I mean, losses can easily blow past 98%, completely wiping out your investment. So here it is. Here's your checklist. Don't react to price alone. You've got to wait for the fundamental story to actually get better. Look for confirmation from high, sustained trading volume, and watch for the price to build a stable foundation, a new base, not just a brief, sharp spike.
And I'll leave you with this one last thought to chew on. In today's world, with high-speed algorithmic trading and social media hype that spreads in an instant, are these bounces becoming faster, more violent, and an even more dangerous trap for the average investor? Something to think about.